Shane, and that is, it's a major focus, especially, I mean, look, you can probably see behind me what's going on in the charts here. I mean, really, what I'm trying to draw attention to, and really the focus is this unsustainable degree that the highly leveraged paper markets have diverged from extremely bullish real supply demand fundamentals. I mean, that's the key of it. And but it's how this divergence has reached these unsustainable extremes. Now, if you remember last time, we were very much focused on the Bank of International Settlements Options Expiry. And this is a huge mark-to-market event, and it's been going on for years, and it usually results in a low being made. And we warned about at the end of October, we'd say it was coming up at the end of October, as it had in September. And it resulted in, it's resulted in a coiled overshoot of fair value. And when I say fair value, I mean fair value that's nothing to do with just the physical market. That's fair value based on the paper to physical supply. And obviously the paper supply is so dilutive. It's really shouldn't be really calling it fair value, but we have to, because that's what we're looking at. And these are the physical support levels, and these were once again driven by the need for officials through the Bank of International Settlements Gold Trading Desk to mark as many unallocated gold positions as possible to market at the BIS OPEX last Friday. And that's obviously since the last episode. And these are the unallocated positions that they are racing to exit ahead of Basel III gold NSFR compliance in just 9 weeks from now. And I think people, we tend to lose sight of this battle that's going on. And so what we're saying is, let's dig into that for a second, because if we look at the detail, it actually exposes some very bullish information. And as we assessed last time, there are very strong physical drivers that we suggested would force the BIS to raise this month's, the October, price cap sweet spot from the 1750 to 1775 September level. If you remember, that's exactly where it closed, into a hell for leather capping event. This is a panicked capping event just to contain physically driven gold as deep as possible below 1800. In fact, the BIS for October closed just inside the lower band of the 1785 to 1795 sweet spot that we'd identified. But the fact is, it had risen. Now, this may not seem much, but it does make a change. It marks a change in their stance. The synthetic gaming into the chart painted PM fix on BIS OPEX last Friday, it was just far too obvious not to be officially sanctioned. Now, just has been the case into every BIS mark-to-market event, it always marks the expiring month's low point before the official cap is lifted. Now, obviously we've got FOMC, we've got non-farm payrolls to come, so obviously that follow through usually comes through, but it always marks the low before the official cap can be lifted. Now, this warped balance, and again, inverted comma balance, is achieved between what the BIS can mark the spot price to market at the PM fix, then it moves into clearing the FX price 1 hour later, and the FX price squaring is where the unallocated gold FX longs are squared off against the dollar at the FX fix. Bear in mind that is a foreign exchange transaction. That's squared at that hour. Then the final squaring of the directly related COMEX GC contracts, which they also have at the pit close. So that's basically the equation. Just because I get so many questions on this, and how do they determine this fixed price? This established a balance price of $1783.90. Okay, that's $27.30 higher than the September BIS mark-to-market event, which was at 1756.60. So why are we taking note of this? I mean, it seems so insignificant, But the raising of the BIS 3-month-old sweet spot was attributable to just one thing: very strong physical demand, which we'll dig into in a second. But the reason we're taking note of this seemingly insignificant stair step, which could easily be overlooked, and I'm sure is, we have to remember the scale of these official mark-to-market derivative events involve billions of dollars of derivative position. So each dollar is billions. So bearing in mind the bearish for gold, strong dollar, rising bond yield drivers. So we talked about how the algos, neutral algos, just tag the relationship with gold or silver futures with bond yields or the dollar. And it provided, because they were bearish into BIS OPEX, which is not a coincidence, it provided really some very assistive bearish tailwinds to drive the paper price, gold price lower. But it still resulted in a $27.30 higher stair step, where at best estimate, we're probably some 350 tons right now of unallocated gold derivative positions needed to be marked to market. Now, this actually represents, if you think about it, 550 billion, and that's a backtrack of 550 billion from September higher, and exposed really more than just a chink in their armor. Now, these are the kinds of things we're looking for: changes in behavior. Now, bearing in mind the BIS OPEX is all about closing off as many long official unallocated over-the-counter gold contracts, as many as possible, before they are rolled onto the books of the agent banks on the 31st of December. Onto which they've laid, if you remember, we've talked about this before, BIS has not sold a single physical ounce. What they've done is create unallocated contracts, leased, swapped them out, and laid them on the books of the banks, of the bullion banks, who are privileged to have gold accounts at the Bank of England. So, but the process of squaring up 100 to 1 leveraged long XAU contracts, which is the gold spot gold contract, where only 1 ounce backs up each contract, involves buying back the dollar leg of this foreign exchange transaction to close off these obligations. And we've explained this before. And the plain vanilla price action that revolves around this action really sends a counterintuitive message to the market, which leads to a price action and that looks bearish. Now, whereas this process bullishly removes, in reality, what it's doing is removing some of the 50 years of COMEX-related accrued overhead synthetic supply. Now, while the COMEX is already Basel III compliant, what we're drawing regulators' attention to is that the CME accepts the over-the-counter paper longs, 100 to 1 longs, bear in mind, as legitimate long hedges to what would otherwise be classified as a naked short, non-compliant Basel III position, which cannot be tolerated in the US. The US is actually now Basel III compliant. What this would do, it would also expose that the degree of these so-called hedged positions actually exceed position limits, because there are position limits, and you can get around those position limits by saying, no, I'm hedged. But so really, this is where things are beginning to change. So bottom line, these over-the-counter longs that offset the COMEX shorts are deemed as acceptable hedges for COMEX shorts. And that circumvents the current Basel III COMEX compliance. Hence, these games continue for the moment. However, ultimately, both the COMEX and the over-the-counter markets must one-to-one represent deliverable physical bullion in just 9 weeks' time. So we must expect intermittent counterintuitive volatility as this scramble to close or allocate these so-called hedges is underway. Now, especially as we move into a BIS OPEX event, and there are only 2 more. So really for November, given the seasonally unprecedented central bank and sovereign physical buying that we are experiencing now, and we'll get into that in a minute, we expect the BIS sweet spot to be driven pretty much a little bit higher than we estimated last time. Somewhere 1850 to 1830 would not be unreasonable, likely with some This time 280 tons of remaining unallocated contracts laid on the books of these agent banks who have gold accounts with the Bank of England. And then the BIS has the option of squaring whatever's left with a keystroke entry. We've talked about this before. And after that, a large rally into the year end will be allowed to unfold with the BIS on the long